How to fund your startup step by step. From bootstrapping to venture capital, 10 detailed steps. Today, we're going to talk about one of the most important aspects of building a business: funding your startup. Whether you're bootstrapping or aiming for venture capital, knowing the right path is critical to success. Hey everyone, welcome back to Money.com, the inspiration for future billionaires. And if you're an aspiring entrepreneur or someone trying to take your startup to the next level, this video is for you. In this video, I'm going to break down 10 detailed steps that will take you through all the major funding options available to entrepreneurs. From using your own savings to securing venture capital, I'll help you understand which option is best for you at each stage of your journey. Let's dive in. 1. Bootstrapping. Use your own resources to get started. The first step for most entrepreneurs is bootstrapping. This means you're funding your business using your own savings or revenue generated by the business itself. Bootstrapping has many advantages. It allows you to keep full control of your company, and you don't have to give up equity or take on debt early on. But bootstrapping requires you to be very resourceful. You need to operate lean, manage your cash flow carefully, and prioritize spending only on what's absolutely necessary for growth. A few strategies for successful bootstrapping include launching a minimum viable product (MVP). Start with a simple version of your product or service and test it in the market. This will allow you to validate your idea without overspending. Cutting unnecessary expenses. Use free tools and software where possible. Avoid splurging on office space, employees, or fancy equipment until your business really needs it. Reinvesting profits. Every dollar your business makes should go back into the business, whether it's for product development, marketing, or customer acquisition. Bootstrapping is a great option for startups that are just getting off the ground and don't need massive amounts of capital. Plus, it allows you to maintain complete ownership and control of your business. 2. Friends and family funding. Leveraging your personal network. If you've exhausted your own savings or need more capital than you can personally provide, the next logical step is often friends and family funding. This involves raising money from people you know and trust, your parents, siblings, friends, or close contacts. However, even though these people are in your personal network, you should approach this professionally. Here's how. Present a solid business plan. Even though these are your friends and family, you still need to show them you're serious. Present your business plan, outline your vision, and explain why their investment is crucial for your growth. Set clear terms. Decide upfront if their contribution will be a loan or if they're purchasing equity in the company. Get it in writing to avoid misunderstandings later. Communicate the risks. Be upfront about the risks of investing in a startup. You don't want to jeopardize personal relationships if the business doesn't succeed. Friends and family funding is often one of the easiest ways to raise initial capital because they believe in you as much as they believe in the business. But be careful. Mixing personal relationships and business can get tricky, so always approach it with professionalism and transparency. 3. Crowdfunding. Raise money and validate your idea. Crowdfunding is another great option, especially if you're launching a consumer product or a creative project. Platforms like Kickstarter, Indiegogo, and GoFundMe allow you to raise money from a large group of people, each contributing small amounts. It's not only about funding, it's also a way to validate your idea and build a community around your business. Here's how you can make crowdfunding work for you. Choose the right platform. Different crowdfunding platforms work better for different types of businesses. Kickstarter is great for products, while platforms like Seed Invest can help you raise equity capital. Craft a compelling story. People back stories, not just products. Your campaign needs to clearly communicate your vision, why your product matters, and what their contribution will help you achieve. Offer enticing rewards. Give your backers something valuable in exchange for their support, whether it's early access to your product, exclusive content, or special discounts. Promote your campaign. A crowdfunding campaign won't succeed on its own. Use social media, email marketing, and even influencer partnerships to spread the word and get people excited about your project. Crowdfunding works best when you have a clear goal, an exciting product, and the ability to engage a large audience. It's also a great way to test demand before going all in on a product launch. 4. Small business grants. Free money for your startup. One of the most underrated funding options for startups is small business grants. These are essentially free money that you don't have to pay back. Grants are offered by governments, nonprofits, and private organizations to support businesses in specific industries, regions, or demographics. The key to getting a grant is to research thoroughly. Look for industry-specific grants. Many grants are targeted at specific industries like tech, healthcare, or green energy. Look for grants that align with your business. Consider government programs. In many countries, the government offers grants to encourage small business growth, especially in underserved communities or areas of innovation. Apply with a strong business case. Grants are competitive, so make sure your application clearly outlines how your business will use the funds and how it aligns with the grant provider's goals. The best part about grants? You don't have to give up equity or take on debt. But remember, grants often come with strict requirements on how the money can be used, so make sure your business qualifies before applying. 5. Business credit cards. Managing cash flow smartly. Once your business is up and running, one of the easiest ways to manage your cash flow is through business credit cards. These cards can give you access to short-term capital, while also helping you separate your personal and business expenses. But like any credit product, they come with pros and cons. Build your business credit. Using a business credit card responsibly can help you build a strong credit profile, which will be essential when seeking larger loans or investment down the road. Take advantage of rewards. Many business credit cards offer cashback, travel rewards, or other perks that can benefit your business. Be cautious about interest rates. The downside of business credit cards is that they often come with high interest rates if you don't pay off the balance in full each month. Only use your card for short-term cash flow needs that you can repay quickly. Business credit cards are a great tool for managing day-to-day expenses, but they shouldn't be used to fund large investments unless you have a clear repayment plan. 6. Bank loans, traditional lending for small businesses. Another traditional way to fund your startup is through a small business loan from a bank or financial institution. Bank loans are ideal for businesses with some track record, as banks typically require financial statements, a business plan, and collateral. Here's how to approach getting a bank loan. Build a strong business plan. Banks want to know that you can repay the loan, so your business plan should include financial projections, a clear market analysis, and a strategy for growth. Have collateral ready. Many bank loans require collateral, such as property or equipment, to secure the loan. Be prepared to put up assets to back your loan. Shop around for the best terms. Not all loans are created equal. Look for loans with low interest rates, favorable repayment terms, and flexibility. While bank loans are a reliable way to access capital, they often come with strict requirements, including repayment schedules and interest costs. Make sure you're comfortable with these terms before taking on debt. 7. Angel investors. Early-stage investors who believe in your vision. Once your business has some traction, you may want to seek out angel investors. Angel investors are individuals who invest their own money into startups in exchange for equity. These investors typically come in at the early stage and can offer more than just money. They often provide mentorship, industry connections, and valuable advice. Here's how to attract angel investors. Network at industry events. Angel investors often attend startup events, pitch competitions, and networking meetups. You can also find them through online platforms like AngelList. Craft a compelling pitch. Angel investors want to know what problem your business solves, why your solution is unique, and how you plan to scale. Be clear about your market opportunity and revenue model. Be prepared to give up equity. In exchange for their investment, angel investors will take a stake in your company. Make sure you're comfortable with the amount of equity you're giving away and the terms of the deal. Angel investors are great for startups that need early-stage funding and guidance. They're willing to take more risks than venture capitalists, but they also expect a high potential return on their investment. 8. Venture capital, high-growth funding for scaling startups. Now let's talk about venture capital, VC. Venture capital is funding from professional investors who pool money into funds that invest in high-growth startups. This is typically used by companies that need a significant amount of capital to scale quickly, often in industries like tech, biotech, or high-growth consumer products. Here's how to navigate the world of venture capital. 1. Research the right VC firms. Not all VCs invest in the same industries or stages. Some focus on early-stage startups, while others prefer growth-stage companies. Make sure you're targeting firms that are aligned with your business. 2. Build a strong pitch deck. Venture capitalists need to see a clear business model, growth potential, and a path to profitability. Your pitch deck should include market research, financial projections, and a clear exit strategy. 3. Prepare for due diligence. VCs will dig deep into your business, including your financials, legal structure, and team. Make sure everything is in order before approaching a venture capital firm. 4. Understand the trade-offs. VC funding typically comes with giving up significant equity and sometimes board seats. VCs often have a say in major business decisions, so make sure you're comfortable with this level of oversight. Venture capital is ideal for businesses that have already gained traction and need capital to scale rapidly. But it also comes with higher stakes, so make sure your business is ready for that kind of growth before seeking VC funding. 9. Strategic partnerships. Aligning with bigger players. Another way to fund your startup is through strategic partnerships. This involves partnering with a larger company that sees value in your product or service. In exchange for funding, they may receive equity or special rights to distribute your product or collaborate with you on future projects. Here's how to form strategic partnerships. Identify potential partners. Look for companies that align with your vision and can benefit from your product. These could be distributors, retailers, or complementary service providers. Offer mutual value. A partnership only works if both sides gain something. Be clear about what you're offering and how the partnership will benefit both businesses. Negotiate terms. Partnerships can take many forms, from licensing agreements to equity investments. Be sure to negotiate terms that align with your long-term goals. Strategic partnerships can provide both funding and valuable industry connections that help your startup grow faster than it could on its own. 10. Accelerators and incubators, gaining funding and mentorship. Finally, we have accelerators and incubators. These programs offer early-stage startups mentorship, workspace, and often some initial funding in exchange for equity. The real value here is not just the money, but the guidance and network that come with being part of an accelerator. Here's how to get into one. Research programs. Look for accelerators that focus on your industry or business stage. Programs like Y Combinator or Techstars are well known, but there are many smaller ones that might be a better fit for your startup. Prepare a strong application. Accelerators are competitive, so you'll need a clear vision, traction, and a well-thought-out business model to stand out. Take advantage of the mentorship. The real value in an accelerator or incubator is the mentorship and connections you gain. These programs can help you avoid common mistakes, refine your strategy, and connect with potential investors down the line. Accelerators are a great way to kickstart your business with both funding and mentorship, but be prepared to give up a small percentage of equity in exchange. And there you have it, 10 detailed steps to funding your startup, from bootstrapping all the way to venture capital. Remember, the right funding strategy depends on your business model, stage of growth, and long-term vision. Whether you're just starting out or ready to scale, having a clear understanding of these options will help you make smarter decisions for your business. If you found this video helpful, make sure to like and subscribe for more tips on growing your startup, and leave a comment below on which funding strategy you're exploring for your business. Thanks for watching, and I'll see you in the next video. Don't forget to check out my other videos on building a successful business and mastering your finances.